If the starting point is today, which is 25th of October 2023, and if the end point is, let's say, 5 years out, 2028 October, are we in for CAGR mid-teen returns?
So this is what I'm telling clients, those who are incoming at this point of time, that you know what, if market does 10, you can expect some alpha from us. However, what I feel confident about is, or what I tell is that, you know, in next 5 years, if we are to generate 15% CAGR, it will not be a straight line journey. Expect at least 2 to 3, 10% kind of correction. Expect 30% correction. It's a given. We don't know what is going to cause it. We don't know when it will happen. But it's a given that these corrections are in the offing in the next 5 years, because last 3 years have been much smoother than they have been in the last 10 years.
You got 3 categories: institutional investors, sovereign funds. It's remarkable that you're managing money for sovereign funds, touch wood. Then you got ultra HNIs, and then you got HNIs. Is the advice standard to all 3? Because everybody has a different time horizon and a different risk profile.
Yeah, no, so absolutely the advice is the larger institutional capital has far longer horizon, and their mandate is also different. The mandate is to outperform the market. It is not an absolute return, while for an HNI or a family office is more absolute return that matters. So from next 5 years, we feel confident about generating positive absolute return, and we feel confident about outperforming the index also. However, if we were to shorten that horizon to 1 year, then I'm not very sure about generating absolute return. There will be volatility along the way for sure.
Same time last year, on the same forum, you made a very loud call, which is that I'm getting out of IT, reducing my exposure to pharma, and I'm increasing my exposure to financials, manufacturing, and alternate energy. That call has worked. But in financials, some would argue that despite delivery, the gains have not been that spectacular.
No, I think that's absolutely correct observation. The financials, because one, there are many firms available, and this is an initial stage where all the boats are rising. So there is no differentiation between X versus Y. All of them are on an improving wicket. You know, the problems in financial sectors come 3 years down the line to understand who has been aggressive in lending and who has been conservative in lending. So the differentiation probably will happen going forward. Currently, we are witnessing some pressure on the margins, which is also kind of holding back the kind of re-rating which we feel will happen in the financials as well. So I think the supply of paper is too much. There are so many NBFCs and microfinance institutions waiting to get listed, and so the supply of paper plus the no differentiation between firms is, I would say, is leading to overall the returns being still earnings oriented rather than there being any kind of a re-rating. So, but I think we still maintain our positive view, because as long as the earnings are growing and the cycle is in favor, there is no reason for us to be getting out of the sector.